Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Summary. Pause. Energy Fuels Inc. remains a strong buy, driven by bipartisan U.S. support for rare earths and uranium independence. UUUU's White Mesa Mill boasts among the world's lowest CapEx/OpEx for NdPr production, targeting $29.39 per kilogram versus a Pentagon price floor of $110 per kilogram. Recent feasibility study projects 33% IRR and first-year profitability, but share dilution and near-term losses make UUUU highly speculative. Position sizing is critical. UUUU's future upside is significant, yet volatility and execution risks remain material. I last covered Energy Fuels Inc., UUUU, a uranium and rare earth mineral miner, in October. That was the third piece of coverage I've given to UUUU, and an upgrade. You can see my full coverage history here, but here's an illustration. Just as in that first article in November 2024, I feel like there are catalysts everywhere for Energy Fuels, and I don't see this latest run-up as just hype, but because of new catalysts that are bringing the firm closer to profitability and more gains. Before we get into the study that UUUU just dropped about its rare earth operations, it's important to cover the rare earth story and what's going on with those catalysts. Here's the macro picture. The rare earth stockpile bill is another step. Political catalysts for rare earth element miners and critical minerals miners at large keep coming, with news dropping of a bipartisan bill going up for a vote, with large existing support it seems, that proposes building a stockpile of rare earth elements. Washington intends to build it up to the tune of $2.5 billion. This is on top of the existing investments already being made into rare earth miners themselves, totaling over $4.5 billion so far. I covered this government intervention in the rare earths market in a previous article. The critical materials rally will continue. I suspect that one of the ways in which the U.S. will continue to fight back against the asymmetry of rare earth access with the Chinese is to invest further into the sector, like they already have with MP Materials, MP, Lithium Americas, LAC, and Trilogy Metals, TMQ. The Department of Defense War has been investing in these operations, giving them the necessary liquidity and impetus to expand operations and close the gaps in our materials mining and processing. Policy to try throwing money at a problem first and foremost, and for those willing to dig through firms and invest in the winners, this move from the government creates a put of sorts, a protection on the price of the market. The government is an unfair buyer. It has access to the money printer. Washington, in the case of MP, has agreed to set a price floor on magnet-producing rare earths that is above the going market price, almost double. They are intentionally paying more to make it profitable for MP to operate because they can't compete with Chinese operations naturally. This is not necessarily a bad thing from a nationalist's perspective, so perhaps it matters whether you lie on the globalist or nationalist axis of the geopolitical issue with China, even if it subverts the free market. They rationalize it by saying that this market is being distorted to retaliate against China subsidizing their own rare earth miners and to create U.S. independence from China in the sector so they can't weaponize access against us, like they recently did with export controls. So this stockpile is the next step in the U.S. game plan to decouple from China in the rare earth market, and I doubt it will fail. I give it an 80% chance to pass unabated. The bill has bipartisan support so far and very likely has the approval of the White House, which has been setting the previous policy of price floors and direct investments in mining companies. Funding would not be difficult to secure among a several trillion-dollar deficit, I'm sure. I am not trying to take on side on the debate of whether market rigging in the face of potential Chinese belligerence is right or wrong, but any strategic thinker that sees this chart should be alarmed. China and Russia control the world's rare earths processing. Folks who do not transact in rare earths may be surprised to learn that they are not incredibly expensive per ounce, like gold or even silver. This price is akin to trying to buy up over half the market. $2.5 billion will make a massive impact on a market barely hitting $4 billion in 2024, the rare earth bottleneck. Now let's drill into the micro picture on UUUU specifically. Energy Fuels is already the largest uranium miner in the US and is working toward expanding its rare earth operations, both in mining and processing, the important bottleneck to address. The chart above with the new axis is only showing processing capacity, not necessarily raw materials. We actually have access to most of the rare earths that we need in raw form, but just lack access to the processing. There's a good reason for this. Processing is very dirty, and the ability to process rare earths cleanly just hasn't existed until recently. The West eschewed processing because it's dirty. Arizona is beautiful, and parts of Inner Mongolia look like Mordor. It can't be helped for the most part. Processing a ton of graphite produces several tons of contaminated water, and nearly 100 tons of dirty water that could never be considered potable again. This is true for most rare earths, that processing produces a lot of waste, though graphite is the most extreme example. This is why the release that Energy Fuels made on January 15th was so important. They released a bankable feasibility study, BFS, on the White Mesa Mill in Utah, a plant wholly owned by UUUU. The result? Energy Fuels ranks among the lowest CapEx and OpEx costs for rare earth oxide production, and one of the lowest all-in costs for magnet rare earths, NdPr, in the world. Their fixed costs on the mill totaled up $421 million, under what was expected. They are now able to process at $29.39 per kilogram NdPr. The going price is near $86 per kilogram, and the Pentagon price floor is $110 per kilogram, for comparison's sake. Because of this, the mill should be able to be profitable in year one and will take a few years to ramp up, hitting full steam ahead in 9 years. The report shows estimates of 33% IRR on the life cycle of the project, with a steady decline in OpEx necessary to keep profits up. This, of course, assumes a fairly linear rise in rare earth prices, which I doubt. I would assume that there is a lot of variability in these projections due to the potential for massive price shocks, like when Washington intervenes in the market. Combine this with a strong uranium market, which is still facing severe deficits in supply due to the lack of expanding mines and the sanctions with Russia, which is a major supplier of uranium fuel to the West. Energy Fuels estimates are for a fairly linear progression in uranium pricing as supply deficits widen over time. Here is the last 5 years, and then projections from TradeTech for the pricing of U3O8 uranium via Energy Fuels presentation. Here's a summary of the report for the technically inclined risks. This build-out period has cost a lot of money, and Energy Fuels had been using debt a decade ago. This chart starts at their peak debt, and when rates start to fluctuate in 2018, they paid off significant amounts of their long-term debt. Then, when rates fell to zero in 2020, they took advantage and paid their debts down to almost nothing. Instead of issuing new debt at high rates now, although they have done some raising, they issued new shares. Share counts jumped last year as they financed significant amounts through equity. Share dilution is a risk for investors because they could be right and the company is successful, but they could be diluted out of their position and left with little gains at the end. There is also the fact that all that profit is in the future and is projected. Currently, Energy Fuels is not a profitable endeavor, and that's a major risk to shareholders. They will have to continue to try to fund operations without taking on expensive debt or diluting shareholders out of their returns. Last year was very expensive as they were putting a lot of money into new projects and getting these plants online. Their quarterly deficits haven't been bigger in recent memory, but that is the cost of building out infrastructure. Nevertheless, it is an important risk for investors to consider. They are not going to get any dividends or pass-through earnings for a long time, and they are relying on earnings to justify an impossibly high price-to-earnings of 107 times. That makes this stock very speculative. That's why I'm invested in it, which warrants the caution I like to give whenever I cover stocks like this. Paraphrasing a mentor of mine, position sizing is often more important than security selection. Based on what we've seen in the latest report from UUUU, it looks like they will be able to bring their earnings up quickly and bring the PE ratio down fast. When that happens, the price may jump, and investors willing to take the risk and speculate on that future may be rewarded. I am invested in UUUU, but my position is sized so that a long drawdown, which happens with stocks like these, won't harm my overall financial health. This is a stock that is most suitable for aggressive investors willing to make a bet on the macro and micro pictures aligning to favor energy fuels. I believe they do, but investors who cannot bear the risk of a 30% plus drawdown could be shaken out of the position too early. That psychology risk is important to consider as well. That 30% figure isn't arbitrary. Between my last update in October and this one, energy fuels is up nearly 10%, but it fell over 30% from the date of the first article's publication between then and now. The prospects for energy fuels are bright in my view, with bipartisan support in Washington through new legislation and executive actions in both rare earths and uranium, via nuclear power. Compound this with a recent report showcasing how efficient energy fuels has become as an individual firm. Make this stock a strong buy to me still, even at its elevated PE ratio. There are great risks, and position sizing is an important factor in an investment made in this stock. However, I believe that the next few years hold significant gains for energy fuels, and the market is still underpricing its potential for growth. Washington has created a distorted market and one they cannot back out of easily. Competition with the world's other great superpower is fierce, and seemingly supported by both Democrats and Republicans. Regime change in the midterms will not slow support for this sector. Energy fuels is on the path to consistent profitability, a fantastic sign. It will still take some quarters to get there, but the foundation has been laid. I am very bright about the stock's future.
Hey viewers, don't forget to like, subscribe, and add our channel to your favorites. We will continue to provide you with more insightful stock analysis.